Are you trying to make a decision between an FHA loan and a conventional loan? Let's talk about the advantages and the disadvantages between these two loan types. I'm Shaheedah Hill, getting you over the hill to home ownership and helping you confidently buy your first home. We're going to talk all about the FHA loan requirements and the conventional loan requirements and some tips as you go through the pre-approval process for a home mortgage. Let's start with FHA loans. FHA loans are a government-backed loan type. It stands for Federal Housing Administration. The lowest credit score for FHA loans is 580, and the minimum down payment is 3.5%. So if you were trying to get a $100,000 house, you would have to put $3,500 down as a down payment. Now, the exception to this credit score requirement is if you have 10% down payment, your credit score can be as low as 500. So 580 with a 3.5% down payment, and if you have a 10% down payment, your credit score could be as low as 500. Now let me stop here for a moment. Now, although these are the credit score minimums, different lenders are allowed to put their own requirements for FHA loans. So for example, if a lender wants to say, well, our minimum credit score for FHA loans is 650, they can do that. So you may find it difficult for you to find a lender that is financing FHA loans at 580. So it's in your best interest to get your credit score as high as possible. I would say for FHA, you want at least a 620 or a 640 to be eligible for multiple lenders to finance you for FHA. And again, for as high as possible for the best interest rates in the 720s to the 740s. Okay. Now your DTI ratio needs to be 57% or less. 57% or less. And this is on the very, very high range because again, lenders can vary this amount as well. So this is like the maximum DTI if you have excellent credit that you may be able to get from a lender. But with DTI ratios, the lower, the better. So if you're not sure what a DTI ratio is, that's your debt to income ratio. I have a full video about how to calculate your DTI ratio here in Can You Afford a House? It will explain how to calculate it. But 57% is the maximum. Okay. Now let's talk about some of the advantages of FHA and some of the disadvantages. Now the advantages, of course, are they will take a lower credit score and they have lower, in general, DTI requirements than conventional loans. Sometimes with low credit, so with borrowers with low credit, they will get a lower interest rate if they do FHA. If they even can qualify for conventional. So you might get a better rate with FHA even though you have a lower credit score. Now let's talk about the disadvantages of FHA loans. One of the major disadvantages of FHA loans is mortgage insurance. If you take out an FHA loan, you will pay for mortgage insurance for the life of your loan. The only exception to that is if you put 10% or more down, you will only pay mortgage insurance for 11 years. But for most FHA borrowers that put less than 10% down, you will pay mortgage insurance for the life of the loan unless you refinance into a conventional loan. So with FHA, they will charge you, if your loan amount is less than about $600,000, you will be charged 0.85% of your loan amount for mortgage insurance. So for a home that's $100,000, you'll be charged $850 per year divided by 12 months. That's going to be about $71 in addition to your regular mortgage expenses. So your principal, your interest, your mortgage insurance, your homeowner's insurance, and your taxes. So you have an additional fee that's going to be there for the life of the loan unless you refinance it to conventional. Okay. You also have a 1.75 upfront, meaning you have to pay it at closing, a a 1.75 upfront mortgage insurance premium. Now you can roll that into the cost of your home, so you're not paying it out of pocket at closing, but they will put that in as one of your closing costs and add it to your loan amount if you don't pay it at closing. So those fees make FHA loans a little bit more expensive than conventional loans. Also, owner occupied, they're for owner occupants only. So if you're trying to invest in property or get some rental property, FHA loans are not for you. They're made for owner occupants. Now, you would have to live in the house for at least 1 year if you plan to rent it out later. But if you plan on renting it out at the very beginning, then it's not for that. They want you to occupy the home relatively quickly, and most lenders will require you to occupy that home within 60 days of closing. Okay. And then lastly, the other disadvantage of FHA loans is that sellers see FHA loans as a little bit riskier because of the more lenient financing, the lower credit requirements, the lower DTI requirements. They feel like maybe that person won't be able to close. Also, it requires more repairs generally than conventional loans. And so that's another risk for sellers to accept an FHA. And then lastly, the appraisal. If the home does not appraise, you are not required to buy that home. You could terminate your contract, get all of your earnest money back if you're under contract with an FHA loan. So all of those things make them a little bit less favorable for sellers to accept FHA loan offers. So if you're in a seller's market, you may be in a disadvantage if you only can qualify for an FHA loan. All right, so now let's get to the advantages and disadvantages of conventional financing. Now, for conventional financing, it is not backed by the government. They're backed by private agencies, Fannie and Freddie Mac. So with the conventional requirements, the lowest credit score, minimum credit score, is 620. However, again, like I said with FHA, it really depends on the lender. The lender can have a higher conventional credit score requirement than 620. So 620 would be the minimum. And then a 45% debt to income ratio is what is generally speaking, what they're looking for. You can go higher than a 45% debt to income ratio if you have more cash reserves or if you have a higher credit score. So again, it really is going to depend on the lender and your cash on hand and your credit score for both of these as to if you can go any higher in debt to income ratio. Now, the advantage of conventional financing is if you put 20% down, you do not have to pay any private mortgage insurance because you have enough equity that if you were to foreclose on the property, the lender feels like they could sell it and still either make money or break even. But if you don't have enough equity in the house, then they feel like they still want that security of having mortgage insurance. I wanted to insert this here to make sure that I'm very clear on PMI. Like I said, you can not have PMI as long as you put 20% or more down when you're taking out a conventional loan. However, if you put less than 20% down initially when you take out the mortgage, you can cancel that PMI when you reach 20% equity. Either you're going to reach that 20% equity automatically after you make a certain amount of payments, or your home can go up in value and you can reach 20% equity that way. You need to contact your mortgage servicer to see exactly how you get rid of your PMI. And like naturally, when it gets to 20%, it'll come off. However, by law, but if your home increases in value, they will not call you and say, well, your home is probably worth more now. Do you want to cancel your PMI? That is something that you have to contact them for. So make sure if you take out a conventional loan, make sure you're very mindful of your equity that's in your home and how much your home is worth. If you haven't already, please do me a favor and please like and subscribe to my channel for new videos like this every week. Now, the private mortgage insurance is usually a little bit lower than the mortgage insurance with FHA. So that's another advantage, that the mortgage insurance amount may be a little bit lower than what you'll find with FHA. Now, another advantage of conventional financing is you can find conventional loans that offer you zero down, so no down payment. a 3% down payment, a 5%, or more. So there's a misconception that FHA offers you the lowest down payment as a first-time home buyer, but it really doesn't. They have 3% options. They have 0% financing with conventional. So you do have a lot of options. You need to ask your lender what options you have available for you if you qualify for conventional financing. Also, with conventional loans, you're allowed to buy second homes and investment properties with conventional loans. Now, the down payment may be more if you're not owner occupying that residence, because investment properties and second homes are generally considered a higher risk than a person's own home where they're going to occupy it. So they usually require a higher down payment with conventional if you're not going to occupy the house. Now for the disadvantages of conventional. Disadvantages are that you have to have generally than FHA, you have to have a higher credit score and a lower DTI ratio. That's why some people will qualify for FHA, but they may not qualify for conventional. And also they may qualify for both, but the amount that they qualify for with FHA might be higher than the amount they qualify for with conventional. Now, if you have a really great income and you have great credit and a low DTI ratio, you'll probably qualify for both, and with similar loan amounts or mortgage pre-approvals. But sometimes if it's a little bit tight, FHA, you may qualify for both, but FHA, you can go higher in the loan amount than you can go on conventional. So what I recommend is that if you can qualify for both, you want two loan estimates. You want to look at an FHA loan estimate and you want to look at a conventional loan estimate. So you can look at them side by side to see which one would be most beneficial for you in the short term and the long term. Because if you have to pay PMI with both and you're not going to have 20% down with the conventional for some years, and you don't plan on living there for more than 5 to 7 years, maybe FHA would make sense. But if you plan on living there long term, you may want to try conventional. If you're in a seller's market and you can't get your FHA loan approved or accepted by a seller, then you may want to look at conventional financing. So if you qualify for both, great. You really want to make sure to see which one would be best for you and your situation. Let's finish with the disadvantages of conventional. So it is that you're not going to easily qualify as you will for FHA. Higher credit requirements, higher DTI requirements, and the rate may be a little bit higher than FHA depending on your credit score. So again, that's why you want to get those two estimates to see, okay, what would my interest rate be with conventional? What would my interest rate be with FHA? Now, I didn't want to leave out the other two finance types. There's also VA loans and USDA loans. Both of these loans are 0% down, but with VA loans, you have to be a veteran or current military. And with USDA loans, you have to be moving to a rural area. But both of these loans are 0% down, 100% financing. I have videos for both, and I'm going to link them below. Thank you so much for watching. I hope this helps you make a good decision, or at least start the conversation with your lender to make the best decision on either conventional or FHA financing.